Hello and welcome back to the Note. We've had another turbulent day of trading on world markets, but at the end of the day, the picture is not much changed. A lot still rests on the big event for the week, which will be the publication on Friday morning of US non-farm payrolls data. Now, this matters because at the last meeting of the Federal Reserve, we heard that their decision on whether to raise rates would be contingent on whether they saw some further improvement in the US labour market. Virtually everybody expects that we are indeed going to see some further improvement. However, that doesn't any longer mean that people are confident that this will translate into a rise in rates, and that is because of the turmoil in world markets. This chart here, which is produced by Bloomberg, derives the possibility that rates will rise above 0.25% at the September meeting from the Fed funds futures market, on which people can place bets on where the Fed funds rate is going. You can see that earlier in the year it was seen as close to certain that we would have had at least one hike by now. Some people thought the rate would have got all the way up to 1%. Now that seems very much less likely. It's dropped very significantly in the last few weeks. That is because people think that the turmoil in markets could well scare the Fed off raising at this juncture. I suspect that as a result, even a really good employment number, say a rise in non-farm payrolls up to 300,000, nobody really expects, even that good a number wouldn't leave people certain that we're going to get a hike later this month. You could have a particularly bad number, below 200,000 or so, convince people that a rate hike has been postponed at least until December. So we have an asymmetric set of possibilities facing us. Don't get me wrong, unemployment data always matters, it's always important, but perhaps this set of data is slightly less important than it was going to be only 2 or 3 weeks ago.